Hello, my name is Adam Trivison. I'm the gaming sector analyst at Gabelli Funds, and I'll be walking you through our liquidity analysis for Wynn Resorts. But first, I'll provide some context on the current state of the gaming industry. The global gaming industry is reeling from government-mandated casino shutdowns due to COVID-19. The shutdowns first struck Macau in early February, right before the all-important Chinese New Year holiday. Since the resorts reopened on February 20th, demand has remained quite depressed due to visa and travel restrictions between Macau, Hong Kong, and mainland China. In the U.S., all 989 U.S. commercial and tribal casinos are closed, most by state mandate, with a timeline for reopening remaining quite uncertain. Gaming companies have reacted quickly to stem operating losses, with executive pay cuts and many companies furloughing or laying off frontline employees. Liquidity has become a primary concern, with most companies drawing down the revolving credit facilities, cutting capex budgets, and working with creditors to temporarily waive covenants. A few gaming companies have successfully accessed debt markets as well. Lastly, management teams are working to assess the potential benefits of the recently passed CARES Act, including payroll tax deductions and deferrals. So where does Wynn Resort stand? Both of the company's U.S. properties have been closed since mid-March and will remain closed by state mandate until early May, although those mandates could be extended. In Macau, both Wynn properties are open, but visitation remains quite low due to visa and travel restrictions. Management has said that the current levels of revenue are not enough to offset operating costs. In Macau, furloughs and layoffs are not an option. In the U.S., Wynn management is committed to paying its U.S. employees full wages and health care until May 15th, breaking rank with many in the industry. The company has said that the costs associated with that decision comprise a sizable portion of a $4.3 million per day cash burn while closed. Management's thinking is that the move is necessary in order to maintain its industry-high service standards. Like others, the company is shoring up liquidity, cutting all non-essential capex, and has drawn its revolvers in both the U.S. and Macau. Importantly, Wynn Macau decided not to issue a final dividend, of which 70% would flow to the U.S. holdco, but is reserving the right to declare a special dividend should it become necessary. Notably, the company was able on April 7th to access credit markets in a constructive fashion, with its U.S. subsidiary issuing $600 million of unsecured notes at a 7 3/4 yield. Note that the oversubscribed offering was upsized from $350 million. So, on to our analysis. What we've done here is take the information disclosed as part of the debt offering and compile two liquidity analyses. These analyses assume Wynn's U.S. properties can continue to pay employees full wages while generating no revenue. Wynn Resort's $1 per share quarterly dividend is maintained, and capex is cut to $80 million in the U.S. The first exercise assumes that Wynn Macau does not distribute cash via dividend. In this scenario, Wynn's U.S. operations have 10 months of liquidity starting from April 1st, hence February 2021. The second scenario assumes that Wynn Macau distributes the $1 billion of cash held at the Hong Kong Listco in the form of a special dividend, with 72% going to Wynn Resorts. Under this assumption, Wynn's U.S. operations have nearly 15 months of liquidity, again starting from April 1st.